way we just have it. But, yeah, I'll be happy to kind of go through all of that. This is going to be for searchers, for private equity, and the ad backs, like you mentioned, is super, super important because people don't realize that, they think, okay, they can just worry about that at the quality of earning stage. But like you said, it comes into play at the LOI stage, at the IOI stage, and really is an important conversation to have. So I'll give you guys a little bit of context on my background just so you know where I stand. But then, I want this to be interactive. So feel free to cut me off, ask questions, feel free to either drop it in the chat or you can just kind of, hop off mute and talk about it. But basically, I've been a CPA for about a decade and came across search and this very fascinating world more around 2020. And that was when I joined this firm called Maury and Schoenfeld, which is a quality of earnings firm. And so what that gave me the exposure from is basically doing deals, working with traditional searchers, regular searchers, and lower mid-market private equity, primarily in the 1 to 15, 18, highest like 20 million EBITDA range of companies. And so from a deal standpoint, that comes around, 3 to 5 million, all the way up to 100 million. Did a few deals in the 120 and $140 million range. But 80% of our deals were buy side. So through that and a few other kind of similar ventures and exposures, I've now done probably about close to 95-ish, definitely more than 90, but not at the 100 mark yet, of different deals, helping from the structuring of the LOI to actually doing the QV, because we were kind of like a full service entity. And so that was an awesome experience. And so now very recently, I just kind of got on my own a few months ago. So now I'm kind of full time in here in this searcher world and just happy to try to help out, from what I've seen from all the crazy stuff. Because we are in this lower middle market, right? So you can't expect the sellers to have all the right financials. And, it's not always fraud. And it's maybe only like so far in all the deals I've seen, maybe only like 5% or less than 10% were actual implications of like, hey, they intentionally messed up the numbers, but a lot of times it's just poor accounting. They'll either the owners doing it themselves or they have like a bookkeeper, or they have their tax accountant. And tax accountants, for those who aren't well aware in the industry, all they care about is like they're not expert bookkeepers, they're expert tax return filers. And so they come in, they look at the depreciation adjustment and book that, but outside of that, they really don't do much else in the book. So if you ever hear a seller saying, oh yeah, we have our tax accountant review it, that basically means absolutely nothing. And there shouldn't be any kind of like that doesn't give you any kind of hope or feeling like that it's actually good. And the reason it's so important in this space is because, in the larger deals, you have audited financials, right? Public companies, 500 million plus enterprise value, everybody has audited financials. So it's not so much of a concern. But the reason it's important here is because you are getting the sim from the broker, or you're talking to the seller, maybe you got off market deals and they weren't ready for a sale, maybe, even if they were, they're just kind of exporting whatever accounting that they have from their system. But there's a whole variety of different errors or different kind of adjustments that we need to make to be able to feel comfortable with what is the true actual cash flow generated from the business. And so there's different numerics and different calculations that we'll get into in a bit, but basically, high level in the future and kind of what we're doing right now is I'm with ACPAs. We're basically the searcher's best friend. So like the right hand fractional CFO in terms of not only like coming into the picture after the acquisition for all the bookkeeping and financial work, but also more so even when you're at pre-LOI and you're looking at you're modeling out the deal and trying to figure out how to get together the LOI. There's some key components that we're going to talk about on this call and over the next kind of 55 minutes as to what are specific things to keep an eye out for to make sure that you're modeling the right number. So let's get into it a little bit. So we're going to talk about ad backs and EBITDA. And before we can even really fully talk about EBITDA, a lot of you guys that might be, working with brokers, which is a good strategy. I mean, for some reason in the search world, it's like the broker is like the enemy, or like, you need to trick them to get the deal. And that's really not the case. I mean, brokers, like they only get paid when you close the deal, right? So they will do everything in their power to try and make the deal work. Yes, they're probably trying to go for a higher purchase price, And so that's why you need to be extra careful with the add backs that they're talking about, because a lot of times they're going to be talking about add backs that are just in the favor of the EBITDA or the net income, and not truly talking about the other set of add backs that are actually going to decrease the net income and the cash flow that's generated from the business. So one key component to realize is that a lot of the times the SIMs that you're getting from these brokers are going to have what's called SDE, right? Sellers discretionary earnings. And that's very different than the EBITDA calculations that are done and that a lot of these models work off of when you're trying to, back into the base case IRR of 30% and trying to get together the right financial models for your lenders. You really have to understand the difference between, sellers discretionary earnings. What they're actually doing is that, sorry, I think this might be a little blurry, but they're basically adding back the owner's salary, owner's benefits, so personal expenses and non-recurring expenses. So they're almost doing like a quasi adjusted EBITDA, and that's another figure I'm going to talk about in a few minutes. But there's all these different kind of total profit numbers that are either EBITDA or SDE. And really what you need to kind of be doing your numbers on is what's called adjusted EBITDA. And we're going to get into that in a minute. But any questions between the differences between SDE and EBITDA and those mechanics before I continue? Cool. Okay, so let's get into it. So now, understanding add backs, right? So add backs on a high level, they're all the things that didn't flow through the financials properly and are things that you need to modify based upon the financials that are provided to you by the seller in order to get to a true net income or true profit number. So what happens is that a lot of times, people won't worry about add backs up until like the quality of earnings standpoint, or sometimes some SIMs provided by brokers have certain add backs. But I want to hopefully try to talk to you guys about just things to look out for. So that way, these are questions that you can ask the seller. These are things to look out for in the financial statement picture that they provide in the documents that they put in the data room. So you can start understanding different types of add backs. And so this is an example, just, I just pulled this off the internet, so, sorry for that, for the blurriness. But basically, one of the key things to notice is that just because you got to EBITDA doesn't really mean anything, right? People think that, okay, the net income to conversion to EBITDA and doing the add backs of interest, depreciation, amortization, taxes, that's gets me to EBITDA and that's I'm done there, That's actually like 5% of the work. The other percent of the 95% is really figuring out, what are the true financials of the business and what are they doing incorrectly. And there's various different types of add backs, so I'm going to get into that in a few minutes. But basically, the goal is to normalize EBITDA. So there's going to be instances in a business where they're going to have negative add backs, where it's like, okay, they're going to have things that hit their P&L and hit their income statement that have reduced their overall profit, but it doesn't mean that it's the cash flow of the business is in jeopardy or anything. So what I mean by that is, if there's one-time expenses, right? If a company has some real estate and they just spend 100 grand to renovate the offices, right? That's going to show as 100K. Well, there's two ways. One thing is you have to figure out how they reported that on the financials, because some people will capitalize that as a leasehold improvement onto the balance sheet, but other people will just run the expenses of the contractors and the materials to do the renovations through their P&L. And so now you're looking at a set of P&Ls that has 100,000 less of income, but in reality, that's not true because that was just a one-time expense. And so that would be a true adjustment. That would be a true accurate add back, where if in 2023 they had that 100K renovation expense, then their P&L is going to be a little less, but you need to kind of add that back to get to understanding more of the true cash flow. Does that make sense? Any questions? Because I'm going to get into the specifics and the types and everything, but just want to make sure I'm not losing anybody as we're going.
So good so far.
Okay, cool. So let's, I'm not sure why these images came out blurry, but this is an example of how EBITDA changes as you factor in certain adjustments. So this is like a mental model that you should have, but definitely something to build out in an Excel. And something that the quality of earnings provider will provide to you. But the biggest problem is that, by the time you get to the quality, and the reason I want to do this presentation and the reason it's so important is because by the time you get to the quality of earnings, you've already signed the LOI. You've probably already flown out to meet with the sellers. You've already dropped money. You've already hired a firm. And so you're incurring so much costs and time and expense that these can all be identified way earlier on in the process. Like when I do diligence with the searchers that I work with, I find all this stuff up front, even before we kind of, even while we're doing the deal structuring and before we even send an LOI, right? So that way you get to a true cash flow number and you don't have to retrade the deal. You don't have to, give your investors more money than they need to initially because, you need to juice the returns because you don't have a true proper net income number, right? Or true proper EBITDA number. So, this is more of a basic, revenue to operating expense, net income, and then they're adding back depreciation, and they should be adding back taxes and amortization as well, but that just wasn't included here. So it just, hidden cells. But in general, you have your EBITDA, but you can see that the EBITDA can change based on all these different adjustments. And a lot of the times, you definitely 100% cannot rely on the broker unless they're like an M&A CPA themselves, because the brokers, I don't know if you guys know this, but it's actually pretty wild. There's almost no regulation to become a broker. You guys could become brokers by the end of the weekend if you wanted to in most parts of the country. There's a few states like California where you need to be a real estate agent, which also doesn't make any sense, right, in order to become a business broker. But unfortunately, I think under $25 million in EBITDA or $250 million of purchase price, I think there's no regulations for business brokers. So the problem with the reason that becomes a big issue is because it's the blind leading the blind in some cases. Again, I think you still need to work with the brokers and they help you a lot. And they're going to be the person that you interact with to derive the financial information and write data that you need from the sellers. But in general, they are not going to be able to give you these adjustments. And whatever adjustments that you see and add backs that you see in a sim, unless it was done by a qualified QOV firm or the sellers, hired a QOV firm to do it. And again, even when I was in the QOV firm, again, a quality of earnings is an agreed upon procedure. So what that means is that there's no law in America and there's no governance to it. There's some general high level stuff that you can't be extra fraudulent, but the quality of earnings done by a seller can hide some of their negative adjustments. These quality of earnings are done in a few weeks. And so depending on the firm, like, okay, if you have a reputable firm, first of all, no firms that are in this space, there's reputable firms in the space, but they're also only spending 10, 20, 30,000 on it. And so they're only spending a few weeks in the financials and they disclaim all liability. So at the end of the day, it's you on the searcher, you guys who have the balls to, take the personal guarantee and risk the opportunity cost of the other salaries and, go all in. It's really important for you guys to understand that these are questions you need to ask and look into to start modifying the number. So that way you're not putting yourself at risk. And I'll show you all these different type of scenarios that should hopefully get the juices flowing. And I'll start, I'll share these slides after the call, but these are definitely like different things. So like what you see here, this is a one-time one-time sale, right? So again, in a big company that did $4 million in profit, 3.9 million, sometimes you'll miss this, you'll just think it's a normal part of the business. But if you didn't ask the question like, hey, did you sell off a division? Did you sell off a big asset? Did you sell off this one time? This is juicing their EBITDA by $400,000 because they just sold this asset one-off one time, which is not a normal part of their business, right? Things like rent adjustments. This is a favorable add back in this case. So maybe they weren't treating rent a lot, but a lot of times these smaller companies are doing cash basis financials. And so the problem though is that the lenders and the investors and the QOV firm is going to do it off of an accrual basis because that allows us to convert it to true cash flow in a better fashion. So that's something just important to keep in mind. And then also one thing about EBITDA in general, and sorry if I'm all over the place, I'm just, trying to cover the important points and a lot of things are just coming to me as I go, but EBITDA doesn't cover CapEx. meaning capital expenditure. So if a business is having varying rates of when they need to buy, if you're looking into a manufacturing company or a construction company or a company that has in general a lot of fixed assets, you're not even kind of picking that up and in EBITDA. And so that's also a very important add back to have, and we're going to get into that as well. So any questions before I kind of go into here? Because this is basically something, like hopefully some of the brokers, there's different levels of brokers too, right? There's their entry level brokers that are selling, the one-off laundromat, the convenience store in the corner, like, the one-off gym. And then the ones that are higher that are in the multi-million EBITDAs, but aren't at the investment banker level, right? They hopefully provide better SIMs, but all of these need to be called into question if they don't have supporting documentation, you know? And I think I didn't have the final numbers here, which kind of sucks because this is super important, but the add backs really change the total net income of the picture that you're dealt with. Now, this firm did something crazy. I mean, it looks like they had a ton of cash and then they started losing business over time. And then, their profits really fell. So that should call into question a lot of different questions in general. But you can see that there's a swing of $300,000. And this is probably only 1/3 of the picture. Fortunately, this broker was, good enough to include these, what we will refer to as pro forma adjustments, which I'll talk about when we get to that section of the different types of add backs. But you see that there's obviously some positive ones to net income, right? Like compensation to owner, that's a normal one. Depreciation, interest, meals and entertainment, those are probably personal expenses. But they're also fortunately factoring in, okay, how much would it cost to replace the owner? But you need to really think about this when you're looking into it, because this is not including your salary when you take over the business, right? This is saying that there's a sales manager that's going to come in to help, quote unquote, replace the owner. But it's great because they at least put these notes section here. But if we didn't have this notes section, we would think that, okay, maybe they're talking about the buyer coming in and taking a 70K salary, which is also probably below market, and you would want to modify these numbers. Generally speaking, I see like searchers, being able to take on like 150K or something, sometimes a little less depending on the deal size, but then it'll ramp up as you're more experienced and as you're more years in the deal, right? Like if you've done a successful search and exit before, and you're buying a 10 million plus, like, or not like a 20 million revenue business, like you can put yourself at 200 or 250. But again, that's a negotiation between you and your investors. But any questions here? Does this make sense? Have you guys seen this before? Yeah. Cool. Let me continue on. I think we're going to get into the meat of it all pretty shortly. So add backs are usually a point of negotiation. So what happens is that the quality of earnings firm is not going to be able to treat any of these add backs as legitimate unless they have proper supporting documentation. So usually that just means like the general ledger. But as those numbers get bigger, then they might actually need like receipts and underlying like bank statements and documents to make sure that it's not just a made up number or just, because I don't know if you guys know this, but there's one really great guy that I like on the search funder world. This guy, Elliot of Guardian Due Diligence. He talks about this too, but like all of these accounting systems can be modified and changed in seconds. Like it's not, and again, if they're modified in a negative way, then that's where the fraud comes into play. But sometimes, and a lot of the times, they're just done incorrectly, right? There's CPAs that get paid 200,000 with 10 years of experience that make mistakes every single day. Because they're in the book so much and there's so many different numbers and workings to do. So mistakes happen all the time. And so the only thing that you can truly trust are the bank statements. And, one of the things that if you choose a quality of earnings partner or if you have a financial analyst on your team is you definitely want to do a proof of cash or cash reconciliation, but that becomes timely, depending on whether you have the team for it or whether you're skilled enough to do it. I've seen searchers make the mistakes of trying to pass that off to interns, and that's super dumb because your intern, there's CPAs of a decade of experience that can't do these proof of caches accurately. And so to expect that an intern is going to do your proof of cache and is going to, try to just pull stuff from the bank statements and put it together is just going to screw you over in the long term. And sorry, I don't know why I'm losing my voice, but I apologize for that. But yeah, I mean, the key thing here, right, is that because you guys are putting personal guarantees on the line, you're putting your reputation on the line. Like this is not the place to cheap out on. It's just very difficult to try. Like you want to save money on the lawyer fees and the deal fees and all that, and everyone thinks they can just use Chat GPT, and myself included. I'm not going to discount myself out, but I just know that until you've been burned, um, you don't realize it, but it's just about you need to do your extra due diligence on this stuff, and you can get these questions answered on the call. So you can ask them like, hey, what is there a credit card on the business that you can use that you use to run through personal expenses, right? Is there other things that post acquisition we need to talk about? And I think I'll give you guys more examples of that in a moment. So this is just negotiating with ad backs. This is again just going back to the point of you need to make sure that if you're trying to juice your net income, right, by boosting it to be able to get, your DSCR, your debt service coverage ratio in a favorable position to get the lender financing. Because I know you guys just want to do the deal, right? You quit your job, every month matters. Your spouse is wondering what's going on, your family's wondering what's going on. You need to show some efforts for your work and the crazy search that you're doing. But it really matters here because at the end of the day, you're putting all of your money on the line, and especially with the PG, like it matters that you need to get the supporting documentation that you can, and that might come into play after LOI, but you should at least have these conversations at the LOI stage, or even pre-LOI with the sellers when you can. And I think what I'll do is after this call, for the people on this call and in general, I'll send over like a list of questions um, to ask sellers that you can help identify ad backs that aren't like egregious. It's all like a give and take, right? Because um, sellers, they love their business, and yes, they're looking to sell, but usually 50% of them are kind of on the fence about selling and are just doing it because like they think that they can get some good money for it. Very few cases are like a fire sale where they unfortunately are getting divorced and need to split their assets, or there's a massive health issue or like a death in the family or something, and they need to sell the business. But you know, you probably have thought about this, but if not, we can always schedule time later. I'll put my Calendly link at the end of this so you guys can always schedule time specific to your deal. But the interaction that you have with the seller is super delicate because if you wrong them or if you kind of like try to show your ego or try to like play them or think you're better because you have some sort of bullshit MBA or some whatever that you have in your background, like they can screw you and mess up your entire life, right? They can hide some documents and hide some details. And if you guys haven't done this before, like I've only been doing this for 5 years and on 90 deals, but there's people like there's insane amounts of things that they can do. And again, you might be thinking, hey, no, like, I don't know what this guy's talking about. I'm going to get all the documents and I'm going to be able to figure it out. Well, the documents themselves can be messed up, and it could just be erroneous errors. Like these are not professional CPAs with decades of experience that are putting these together. These are construction people or technology people or engineers or whoever you're buying, whatever industry you're buying a business in. The seller or the bookkeeper that they have, it's usually a family member or an outsourced accounting firm or a fractional CFO that just hasn't done this before. I come from a family of CPAs. My brother and sisters are in the Big Four, and one's even a partner at the Big Four, and they don't know what the hell quality of earnings is. They don't know what a proof of cash is, because that's not dealt in accounting. That's a very specialized, scrutinized type of industry and type of product that is being that we do and deliver for searchers and mid-market private equity people and strategic acquirers too. But yeah, just things to come into play. Yeah, sorry, I'm just kind of rambling a little bit, but I just know that this is important and things to kind of keep an eye out for. But we're about to get into the meat of it all and kind of go over all the different types of ad backs. So any questions before we go on there?
Yeah, just uh, one question around deal dynamics. In the past, when I've put in LOIs, where like my earnings number has been different to what the broker has, or what the seller thinks that their own earnings numbers are, it's been a bit delicate. So I guess any advice on how to bridge that gap and kind of message that?
Yeah, so amazing question. And so the way that we usually recommend doing that is that you put the purchase price, but then you also put in parentheses that the way you got to the purchase price, whether it's X multiple of EBITDA. And so, that way you have a confirmed EBITDA multiple. But if it changes, which it definitely will change, I've never seen one deal in the last 90 deals I've done where the true EBITDA number advertised was different from the final adjusted EBITDA number after the QV. When you get that change, you can modify the purchase price accordingly because you already told them, hey, I came to this $7 million purchase price because I did 3.5x of your EBITDA that you advertised. And so this will be, at the discretion or after due diligence, when we got to the true number, then that negotiation with the seller becomes a lot easier because you put it in the purchase price and they'll know mentally in their head, they know their business pretty well, right? And sellers, like, business is a tough game. I mean, I don't know your guys' background and stuff like that, but after you've done 10 years of entrepreneurship, you become a different person and you need to kind of like, you know, we can talk about that another time. But in general, the sellers will know whether their net income number is true or not. And so when you put that parentheses EBITDA multiple, they'll know if they kind of juice the numbers a little bit and that conversation will be coming eventually. And so it's not like a big turnoff when it happens, when you need to retrade the deal and the final purchase price at close.
Thanks.
Yeah, yeah. But that's definitely a great question. And that's another thing I'll send you is kind of like some good LOI templates and like structuring details because obviously you want to use an attorney. I mean, a lot of people again with ChatGPT think that they can just get away with not using an attorney. But highly recommended. Again, it is non-binding, but the thing is that it sets the expectations. Always blame your bank. Yeah. Well, the bank is the only people that I imagine you mean your financiers, like blame the debt lenders. Yeah, that's always good. You can do that. And you should do that, I think. That's definitely a good way to play it, that, the underwriting is the issue from the debt side or the equity investors, because you need to be the seller's best friend. You need to be on their side of the table. Like even the way I mentor some of our searchers is like, if you walk into a room with them and you meet them and there's a table, you don't want to sit across the table with them. Like what I do is tell them, grab that chair, move it around, sit on the literally same side of the table with them, unless there's like no space or something. But you want to be on their side and you want them to trust you because then you can get amazing terms. They'll work with you through the bullshit. They'll pull things out of a hat when you need it. Like, they've been in this business for a long time. They know where the dead bodies are, where the issues are, right? And on day one, when they first meet you, you're just a paycheck to them, right? You're just their retirement. But they're people too. You can actually build a relationship where they'll actually start to like you and actually build rapport with you, and they'll start to give you out more of there's one thing, there's a lawsuit coming up, like, it's not filed yet, but we did have this issue. So, it's not filed, they're not required to disclose it, but if they like you, then they will. Or, oh, this might be the right revenue opportunity, or this might be, this guy's actually going to leave. And so I know in your model you were banking on them staying, but they actually told me that they're having some family issues or they're going to move, right? And so the seller's never going to tell you that stuff on day one or even month one, because again, you're just a paycheck to them. But if you can build, and this is like, Chris Voss negotiation tactics, this is like psychology thing. What was that, Robert Sinigi, whatever his name is, that influence book, right? So like, this is psychology tactics of, you can really set yourself up in a proper position or screw yourself for life if based upon the way that you treat your seller. We always generally tell our targets that our lenders won't allow us to pay more than X times EBITDA. Yeah, true. And that's true, because if you can't, especially as you built the rapport and you're on the same side of the table as the seller, like, you know, you want to be upfront with them. Like, listen, hey, I want you to get your retirement check, or I want me to be the reason you become a millionaire, but you need to work with me to get you there, you know? Um, so yeah, things like that. And I might do another whole call on that because that's such an interesting topic. I've been in, you know, some searchers do it so well and some people do it so terribly. And it almost makes me like cringe. Like, dude, you're like, you don't understand that the seller can just literally take the money and dip. And 10% of them do that. You know, they can sign whatever they want. You can hold back 10% in escrow. Well, who gives a shit? They got 90% of their money and they know that you're going to find a bunch of dead bodies and a bunch of lawsuits. So they'll take your 90% and dip out and never, you know, reach out to you again. And really, once somebody leaves the country or somebody that has a different nationality outside of the United States, you're never going to get them. And lawsuits in general take years and years and years. Like, I don't know if you guys have ever been through lawsuits, but they're terrible. Like, they usually never work out in anyone's favor. You'll spend 6 figures trying to make 5 figures. Like, doesn't make any sense. Or 7 figures trying to make 6 figures. Especially any lawsuits that go to trial. Like, that's like a 10-year process. So it's very important that you build a rapport with the seller. Sorry for getting off topic, but that matters even more than ad backs, honestly. So definitely just a good thing to talk about. Cool. So let me dive into now what you guys hopefully actually came here for, which is the types of ad backs, right? Because there's 4 key elements, the 4 buckets of ad backs. 3 of them, the ones here on the left, kind of fall in the EBITDA bucket, the profit and loss, and the income statement bucket. And then 1 falls in the working capital bucket or the balance sheet adjustments. And honestly, I mean, I'm just coming up with ideas of stuff of future calls, but I'll probably do a whole nother call or kind of recording on working capital because that is a massive conversation in itself that if you don't really understand, and believe me, it's very easy not to understand it. Like there's accountants that also don't understand what working capital is. So like just feel free to ask the question or like ping me if you're on this call, like ping me, let's talk about it. But yes, there's a formula of current assets minus current liabilities. But if you don't really know what the hell that actually means and true mechanics of running a business, and if you haven't run a business yourself for at least 5 years, then like hire and pay or attract or partner with the right people because the corporate world and the academic world and the MBA world is a whole different ball game compared to the true entrepreneurship. What the hell is going to happen when you actually buy a business and you're now a CEO post acquisition? And it's a great thing. It's very fun. It's like it's awesome, but it's definitely not teachable in any of those other corporate world. If you've ever worked at a firm with more than 1,000 employees, you don't know. Like none of that is relevant to running a business that's less than 100 employees. MBAs, all that, whatever. I don't want to keep going into that, but let's talk about adjustments. So 3 types of adjustments, P&L, let's talk about due diligence. That's the one that people think about most often. So that's the one that you've probably come across, which is, hey, we're going to add back the owner's compensation. We're going to, you know, personal expenses that are run through the business. We can add it back. One-time, non-recurring expenses, like I talked about in the beginning, you know, the tenant improvements, that ends up being an add back. So those are the non-recurring, non-operational, and extraordinary items. So what that means is that things that aren't related to the direct operations of a business, right? So like if you're, I don't know, let me come with a company, right? And you are, you know, you make your money from your construction deals and, you know, the projects that you do there, then we only worried about that type of cash flow. But if you happen to, you know, once a year you flip somebody else's used equipment or something like that and make some profit, that's not part of the normal operations of the business. And the SBA will not take that as an add back or allow that to be included in your profit, but also it should be something that's adjusted out. So just keep that in mind. Like those are like the one-time adjustments. And that's the most easy bucket that I think everyone thinks about. I think the one that nobody or people think about a little bit, but don't actually understand the impact is the accounting adjustments, which is the cash to accrual. Almost even in the 90 deals I've done, even the 120 million, $150 million deal I did, it was not true GAAP accrual accounting. It was what they call modified accrual, which is kind of like the community adjusted EBITDA that WeWork used to have, which is, they're doing accrual whenever they remember to do it. But if they forget, then who cares, right? Because again, it's a private company. They're not required by law to govern their books in any way. Tax returns, which is the only legal thing that they're responsible for, are on a cash basis. So they don't even worry about accrual basis outside of, the M3 schedule, but that's another, oh, sorry, the M1, but that's another conversation. So the accounting adjustments, this is something that comes into play a lot because, well, I'm going to just show you example. After this, I'm just going to show you exact examples of how it's all impacted, and that'll get you going. Let me just kind of get off this page. So the last thing, the last two items are pro forma adjustments, which again also affect the P&L. And this is stuff that no broker is going to add to their financials, right? Because this is a buyer problem, but the SBA cares about it, your debt financiers care about it, and your equity investors will want to see it in the model of what's going to happen after the acquisition, right? So the most basic one is pro forma compensation of the new owner, right? So that's, what your salaries are going to be. That's the general one. But how about, if right now they own the building and they're not going to sell you the building and they're going to ask you to rent the building after, rent the office after, that new expense that wasn't, maybe they weren't paying rent, market rent month over month, that new rent expense that's not going to hit the P&L needs to be factored in. Or maybe, this happens a lot. There's amazing new contracts that are coming in, right? New revenue, new forecasted pipeline, amazing, right? However, to service that, again, the broker's not going to tell you this, the seller's not going to tell you this unless you ask them, how much additional operating expense and how many extra people do you have to hire to service that? How many new softwares, how many new insurance policies do you need to, how much do you need to up your insurance premiums to service that client now, right? So that is a pro forma adjustment that comes into play, which again, no broker gives a shit about because that's your problem. That's the buyer's problem. But you need to take that into account because you need to understand, again, after I buy this asset, what is the true cash flow that I'm going to be able to generate? And so we're going to get into that. And then, yeah, working capital are the balance sheet side of things, which again, massive topic. But I wanted to get into now just examples of all these buckets. And then, I'll leave like 10 minutes at the end for questions. But again, as I go through each one of these, if there's questions on it, feel free to let me know. So talking about due diligence adjustments, right? If we do have owner's compensation, right? That's pretty simple. That's like the owner's compensation gets added back. That I think everyone knows, but it's still a question to ask, you want to confirm anytime you see an SDE or an EBITDA or a net income or a cash flow number that brokers like to put on. Again, they're not CPAs, they're not accountants, they haven't spent 20 years in this game in terms of like from an accounting perspective. So you need to clarify, hey, can you tell me what equation or what formula you use to get to that number? Like I see it more than 50% of the time. They've confused SDE with EBITDA. They've confused adjusted EBITDA with SDE. They confuse cash flow with net income. Like they just put a word there, right? So my main thing is just you just have to understand this is a complicated game, and you have to just like trust but verify every single thing. So that's owner's compensation. That's an easy one. The non-recurring expenses, and this bucket is the easy one that I think you guys, hopefully if you've done some research, you know about how this impacts. But again, the reason this is important is because let's take a look at the valuation impacts of these, right? If you didn't factor this in when you were running your model and drafting your LOI, your entire valuation is off. Because you have to remember that, yes, you might have missed $50,000 of expenses, but when you multiply that by your valuation multiple or your EBITDA multiple that you're putting in front of the seller, then each $1 mistake comes out to $3, $4, $5. And when you kind of multiply that for 100,000, you're getting into some crazy numbers. But yeah, definitely the Matt's comment. Yeah, that's definitely a great one. Again, relationship with the seller, it's you on their side. It's never you against the seller. Yeah. So, one of the ones, again, the non-recurring expenses, this is an increase in valuation, but sometimes the company will have certain expenses that are just one time, or transaction related expenses, like if they're getting ready for a sale and they paid maybe a QOV firm or an accounting firm to clean up their books, right? So those are one-off expenses that you would do an add back to. And then we talked about the one-time income scenario as well, like the gain of a subsidiary or the gain on a sale of an asset, or maybe they did a one-off project that isn't a normal course of business for them, but they just juiced their P&L for that one time. And that's all very important to kind of understand that the income, yes, it's 120,000 reduction in EBITDA, but it's a $500,000 reduction in valuation. Yeah, great question, Nate. So Nate's asking, what's the conversation like when the seller believes it's a one-off, but you think there's a high degree of risk that it occurs again next year? Great question. That happens all the time too. It usually means at that point the seller still doesn't fully trust you and is still, trying to maximize their paycheck or their, money in their pocket at sale. But it is a difficult one. Matt's comment again of like, hey, unfortunately, because of the SBA or because of our lenders, we have to treat that as an expense. But you have to pick and choose your battles, right? You're going to come into at least 50 issues, literally, in every deal, even a small deal, right? And that's kind of why they say like a big deal is more worth it than a small deal, because it's the same amount of work. So you might as well kind of just go bigger. But you're going to run into 50 issues or 50 points of dispute that you're going to have with the seller. And for anybody that's been in a relationship before or is married, you have to pick your battles, right? You cannot just, it's going to break if you go after each and everything. So you have to keep things in your pocket. And that's what I help my searchers do a lot is I help them find all these important things. And then we game plan like, hey, keep this stuff in your back pocket. So that way, if shit hits the fan later on down the road, you can bring it up and you can reach a compromise. So it's not just like, hey, you tackling the seller, like, oh, you guys messed up on these financials, or, yeah, you're talking that this was only a one-time thing, but I know it's going to be multiple times. You have to pick and choose your battles and the materiality of it. How big of an impact does it make, and does it make or break the deal, right? So yeah, hopefully that answered your question, Nate, a little bit. But yeah. Sorry, Clements, I'm not sure if you're gonna say something or but yeah, no worries if not. Cool. So that's due diligence adjustments, right? Let's talk about now accounting adjustments. So accounting adjustments are when you're doing the change from cash to accrual. And I'll send you guys these slides after. I don't want to run out of time, and there's still a few interesting things I want to poke into. But the most important thing I would say is the accrual basis revenue, where revenue, sometimes these cash basis companies, they record it when it's deposited rather when, ignore return, but rather than, again, in true accounting and in true GAAP, you can only record the revenue when it's recognized, meaning when you've actually performed the service. So a lot of times, here's a big thing. A lot of people, oh my God, this is crazy. A lot of searchers think that they can get to an LOI or get to a deal without having a balance sheet. And there's so many brokers that think that you can make an offer without a balance sheet. If you don't have a balance sheet, you're basically, you might as well just throw something at a dartboard and throw whatever random money at. Because the thing is that on the balance sheet, if you don't see a line that says customer deposits or deferred revenue, then depending on the type of business, of course, you're dealing with, but any company that deals with deposits or money up front before the services are paid, like a deposit or retainer, like construction industries, software companies, right? Software deals, they might take 100% up front, but then they have to service you throughout the year. So like if you don't see that line item, then you have to be super wary, because what that usually means is that they're taking that full 100% deposit or cash up front or whatever, and they're recording that as revenue when they haven't recognized the relative expense yet, right? And that becomes super important, because if you buy this company and they have $1 million in deposits and you don't talk, and that becomes a working capital issue down the line, but now you have to service all the $1 million that they've already recorded as revenue. And so you have to make sure that you have the proper cost of sales and everything. So again, I wish I will get into it more. I just want to talk about it on a high level here, but happy to, schedule calls with you guys on a one-off basis based on your deals. And as you come across different deals, that's what we do. That's what our firm handles. Um, but yeah, definitely just something to keep in mind. Like if you see any company that doesn't have deferred revenue and doesn't have customer deposits or a liability on their balance sheet, then and you know that they have some sort of deposit mechanism or they take some sort of upfront cash in their business and their revenue model, that's a red flag right away. And that'll drastically change the valuation and change the range that you can put in an IOI or the purchase price you should put in into a LOI. And so it kind of sucks. I mean, this isn't always great because I mean, I'm working with a broker right now who just gave a SIM and she is not giving us any other things until we submit an IOI. And they have a customer concentration where one of their customers is like 65% of the business. And so, yes, you are going to unfortunately it's not going to be as clear cut as I'm making it out to be, but it's like things that you need to put on your radar and things that, just build in conservatism here because yes, you want to have the best offer and you want to win the bake off or the IOI or the auction so you can get to the LOI, but you don't want to shoot yourself in the foot. And that's why searching takes sometimes 2 years, if not more. And why 1/3 of searches don't work out because they just weren't finding the right deals because market timing, luck has a factor in it. Like you're gonna have to look at several hundred deals before you find one that you should put, LOIs in front of. And then you have to, at least the math is pretty crazy. It's like on average, 3 signed LOIs, only one of them go through. So 2 out of 3 signed LOIs break, right? And so that's probably something I'll put in is I'll add a slide in the future of like the economics or the kind of numbers that work out. But it takes time. Like to find the right deal is going to take time. You know, hopefully when they present you with the financials, you're in a better position, but you have no idea if the financials are even done right. Who's the bookkeeper, right? Who's putting these financial transactions together? Again, most of the times, more than 50% of the times, the inaccuracies are not due to any malicious activities. Actually, 90% of the time, it's not malicious activities. It's just kind of incompetence. Accounting is not easy. Accounting is very difficult. There's accountants that, again, of a decade plus that make mistakes all day long. There's partners at accounting firms that make mistakes all day long because you're just looking at so many numbers in so many fields in so many months, and you're gonna miss one. And unfortunately, sometimes if you miss one that's a material one, it changes the entire game. And so nobody cares about this as much as you do because you're putting your family's money on the line, you're putting your future on the line. And yeah, just the thing to put out there. So any questions here before I move on to pro forma adjustments? Okay, cool. So let's get to pro forma. So now this is the post-acquisition adjustments. So this is the stuff that, again, I doubt any broker, any SIM, anyone's going to put in there. I know that SVA or debt financiers and lenders tell you at least that, hey, you have to add back your owner's salary. I mean, your buyer, new post-acquisition, you have to add your salary or deduct your salary from the cash flow from the EBITDA so you can get to that adjusted EBITDA number accurately. But there's other stuff that comes into play too. Again, future management structure, right? So if it's like if you're doing a duo search, or if you know that, hey, I'm gonna have to bring in a future bookkeeper or future customer service person or any other hire or implement a new software, right? A lot of these searchers are, hey, I'm the AI guy, I'm the tech guy, right? I'm gonna blow up this company in a good way by adapting technology. Like the seller hasn't thought of that, but that's another topic, but every searcher thinks they're going to come in and change the world with technology, but factor that cost in, right? These solutions cost a ton of money. CRMs cost 5 figures. Prospect leads cost 5 figures. These full out, why am I ERP? Sorry, I don't know why. I as accountant should have never blanked on ERPs. ERPs cost 6 figures. Like if you're about to change the game technology wise, you have to remember that you have to model that in because you don't want to be out of cash when you're trying to implement a solution. And then, yeah, again, going to the salaries of like, okay, yes, there's all this amazing, they're signing, their forecasts are awesome, their pipeline is beautiful, but are you factoring in all the additional hires and all the additional costs and the new office space and the new software license fees you're gonna have to pay in when you get that new business, right? So make sure you just factor that in. I'm sorry, I don't mean to be harsh at all. I just mean to be kind of frank because again, like I've seen this a lot and it's just super important. And when searchers don't see this, I mean that's why I'm here. That's why our firm's here. That's why, hopefully this is helpful. I hope I'm just not like some weird idiot that's talking right now, but hopefully this is, hitting some of you guys. But yeah, it's just again, no one cares about this as much as you guys will. And so yes, you hire the QV firm, hire the accountant, hire the CPA. But if the QV firm misses something, they have zero liability. If they were off even if the entire thing was wrong, the first page of their QV and on the engagement letter says that they disclaim all liability and you indemnify them from all liability and misaccuracies and misstatements. So yes, they're going to do their best job because they have the reputation and they have the experience. But again, you're just a paycheck to them. Like for the QV firm, you're just another one of their 50 clients. And for you, this is your family's, money and your future on the line. So just make sure that you spend good time on it and learn it and figure it out. Not that you have to go out and become an accountant, but honestly, it's probably worth, spending a few $100 or a few $1,000 and doing a 8, 10, 1 week accounting class and really just understanding the mechanics of it so you can at least get a little bit into the weeds of understanding it. Again, it'll just help you sequentially to kind of get more under the weeds of like, oh wow, I didn't even think about this. Especially if you're not super comfortable with prepaids and accruals and recasts and deferred revenue and working capital, if those comments that I just mentioned, those words that I've mentioned, if you understand them vaguely, but if you couldn't recast, a year of payroll accrual for me right now, then just try to watch a few YouTube videos on it because it's going to change the economics of your deal and the underwriting of your deal drastically, depending on the industry, like in healthcare industries, home care industries. That's a razor thin margin industry. It can be beautiful. And somehow there's been a lot of searchers that have made a lot of money in that space, but they play on pennies. They play on, hey, my payroll wage is $23 and the insurance company pays me $25. And so because of the volume of spread of the $2 spread, that's how I make my money. But they have 250 employees, even in small entities, right? They're 250 caregivers because you have basically a lot of part-time employees because you can't 1099 them legally because you're telling them a schedule, right? So you don't want to run into a payroll lawsuit and get sued for 6 figures for that. So you have to put them as employees, but then you have cash basis payroll expense when it should be accrual basis because you're not paying them until 2 weeks after. And so you think, hey, it's not a big deal. But again, it ends up being a 70K adjustment on 1 year, but you're paying 5X multiple for that. That's a $350,000 valuation change. And that's your $350,000 that's being affected by just not picking up that one small thing that you didn't think to look into or you didn't even know how to, right? So yeah, I know we're kind of coming out close. I'm going to share with you guys these slides. Super important. I would be happy to talk more about this with you guys as we go. Again, just kind of recapping, all these ad backs need to be identified. You need to have source documentation. So even if you get that nice sim that I showed you in the beginning that has that bridge, I still wouldn't trust any of these numbers until I see a statement. And again, a general ledger or an Excel file, anybody can make an Excel file. Let me see the payroll stuff. Let me see. The only people that can't change their stuff is the bank statements. And unfortunately, I've also dealt with deals where the goddamn people change the bank statements. And so that's fraud, right? That was a fraud deal. But I would say 5 to 10%, one in every 10 deals, one in every 20 deals are fraud. Like the sellers are doing fraud because you're about to make them a millionaire. They're going to retire in Europe. They're never going to hear from you again. And yeah, so just keep that in mind. So yeah, just to close out, hopefully that was helpful. I apologize if I went on some random rants and tangents, but I think I can help you guys out in two ways. If pre-LOI assistance or financial modeling, happy to help hop on a call. Or if you have a deal under LOI and looking for a QOV provider, let's chat. I'll drop my Calendly link in the chat so you guys can kind of book some time. But yeah, have 5 minutes and happy to stay on after if you guys have any specific questions to the deal that you're dealing with. Any questions on the presentation. Happy to chat and stick around for a couple minutes.
Well, thank you so much. This was really helpful. I'd love to schedule some time next week, but is there any way we could get a copy of this presentation and kind of
Yeah.
finish out our notes?
Yeah. I will send that over. If you guys can do me a favor, because I did this on Search Funder, if you can drop your email in the meeting chat, I can just make sure we capture everybody, and that I don't miss out on anybody. So yeah, if you can just drop your email, and I'll make sure everyone gets it. It'll be great.
Yeah, really appreciate the presentation today. Real quick, is there a certain type of line item in add back that you see, maybe not fraudulent, but maybe overstated more than others, like legal fees, personal? Like, what do you think is the biggest red flag that you see in there?
So the number one red flag the great question, by the way, the number one red flag is deferred revenue and revenue recognition. Like if you're going to spend any time learning accounting, and that's the number one thing you need to figure out, because that is a big deal. That happens all the time, and it becomes a problem, especially when it comes to working capital. Like the understanding, and most business owners that are running their business, like I just sold or helped sell this pool construction company for $19 million. They were construction people, been in it for a decade, built an amazing business, 20 million in revenue, super smart, super competent people, never heard of working capital before, right? Because they're construction people. They know how to build a construction business. They're not thinking about their business from a working capital standpoint. They're thinking about it as like, let me just make sure I have enough money in the bank to pay my bills and scale the company. So the number to answer your question more directly is, I think the fraudulent one doesn't happen too much, and the legal expenses, the one-time expenses, those are things that I usually help my searchers with juice a little bit when it's like, hey, we need to up our EBITDA a little bit. Because there's kind of two games you're playing, right? You're trying to play one game of understanding true cash flow for yourself. And then there's a second game of how do I get this deal underwritten? Because unfortunately, or fortunately, maybe sometimes for the seller, I mean, for the searchers, the SBA is also not that great. And these debt SBA brokers are also not CPAs or accountants. So if you model it in your favor, as long as you yourself know the real numbers, you can model it out in a different way to make sure that, hey, the add backs of the legal fees, or the personal expenses that are coming out, or whatever, that those are the smaller ones. The biggest one that I would say that you guys need to take a look at this weekend, or pay somebody for to teach, or happy to hop on a call to talk about it, is deferred revenue. Because so that becomes a big negotiation point, and I've seen deals fall apart a lot from that. That's probably a third of the reason why deals fall apart, is because of improper revenue recognition leading to an improper working capital designation in the LOI or in the purchase price. And again, the problem is that this happens so late in the game, because you don't true up your working capital until 90 to 120 days after close. And so I've seen people that had amazing rapport with the seller and would have had a great future, but then had needed to do a working capital true up of $500,000 3 months later, and the seller already spent the money. And so so now the entire relationship was ruined, and they had to basically fire sale the business because the seller hadn't fully finished, converting all their knowledge over, and they had personal relationships. And, that's more of an extreme case, but it happens. And, that is the number one thing that make sure you understand is revenue recognition, deferred revenue, and that whole customer deposits standpoint of when does the company recognize revenue? Because if it's just when it hits the bank account, that's a red flag, and you need to identify that earlier rather than later.
Great, thank you.
Yeah. Cool. Yeah, I think anyone have any other questions? But if not, again, I'll drop my Calendly again one more time in the chat. Happy to talk. I'll drop my email too, actually, in case you guys just want to reach out to my email. Happy to, and I'll put that on the slides as well. And kind of, I'll touch up the slides a bit to make them nicer and fill in the gaps that I identified while I was putting that together or doing this. But yeah, really appreciate the time. Thank you guys. And yeah, happy to chat in the future if you guys have anything that comes up.
Great. Thanks. Have a great weekend.
Thank you. You too. Take care.
Thank you.
Thank you.